Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv Narayanan, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Andrew Pierno of XO Capital. And what's really interesting about XO is that they're buying really small businesses, often with less than 10K in MRR, and that are either single purpose tools or product led growth companies. And we spoke to Andrew about this investment philosophy and how down market at this level, they're barely seeing any competition, and what their investment philosophy is in terms of creating value with these kinds of investments. So it's a super interesting conversation, and it's almost anti-VC and anti-growth mode type of philosophy that a lot of companies take in trying to take their companies to the moon, even if it's not practically possible. So I enjoyed that part of the conversation. And also what's interesting is that Andrew's the technical lead on these investments. So he often has to rewrite the code for these products. And I think that's part of their secret sauce is they have somebody like Andrew on the team so that they can buy these small technology businesses and continue to operate them at high margins so that they're profitable to keep those businesses going. So it's a super interesting conversation. It's very different from the larger PE investors that we work with and we've had on the show. So I hope you take that away from the episode and enjoy Andrew's perspective. Enjoy the episode. All right, Andrew, welcome to the show. How's it going?
Good. Glad to be here. How are you, Shiv?
Good. Excited to have you on. So why don't we start by giving the audience an intro about XO Capital and your role, and we'll take it from there.
Sure. So XO Capital, we started about 3 years ago. We buy really small, and by small, I mean actually very, very small SaaS companies. We've bought 10, we've sold 5, and we currently operate 5. And yeah, we just raised our first little fund. The first 10 acquisitions were all bootstrapped. We're still kind of a bootstrap company, and we're just looking to deploy the cash we just raised from our first little fundless sponsor.
And how big was the initial fund?
$500,000 we raised. Yeah, so it won't be our biggest acquisition, and we're just going to buy one company with this. So the fund is quite small.
Got it. And when you say up until now, the first 10 acquisitions were bootstrapped, that means like you and the co-founders have been buying these companies out of your own personal capital?
Correct. Yeah, it's me and 2 others, a gentleman named Henry and Danny, and it's just the 3 of us in our own cash.
And what's the thinking behind this? Obviously, there's been an increase in M&A and in general, and even down market, you see platforms like acquire.com where people are buying and selling smaller businesses. But just walk us through the thesis here of investing in these, I would say, more immature businesses that haven't really figured out everything yet, but you're still seeing value in that. So help us understand where you see the value there.
So maybe I can start out with a history lesson. I was at a venture-backed company. We raised about $8 million. We spent a little bit more than that, and it went to zero. This idea that we spent many millions of dollars investing into a product in a business that didn't meet venture criteria to then go get a Series A, B, C, D, et cetera, that doesn't mean that we created $0 worth of value. We had a kick-ass product. We had customers, right? There was revenue. And the value of that business ultimately went to zero because there wasn't really at that time a marketplace, and who's buying these businesses that have, sub $1 million of revenue. A lot of these bigger companies can't even do diligence for that little amount, right? So again, there's this gap between, okay, we raised a bunch of money, awesome team, great product, some customers, and yet the value at the end of that 5-year journey was the market value that at zero. And I don't think that that's true. So, I got my ass kicked on that one, right? I wasn't a co-founder there. I was a hired gun, but I was CTO and there for a long time, and that sucked. And so I thought, okay, maybe there's a better way to do this. I bet there's a bunch of other companies out there that have also gone on this trajectory, right? They raised a bunch of venture. I mean, we're looking at one today. They raised $4 million of venture. They built an awesome product. The business is growing. It's small, but it's growing. It's just not growing at a rate that is acceptable to lead to get a next round of venture, and that's okay. not every business is going to, it's a great big funnel, right? You've got seed, then you've got A, B, C, D to whatever. And there's a bunch of fall off on each of those steps. And there's a ton of value at each of those things at each of those steps where there's some fallout. And we think there's plenty of value to be captured there. So there's that kind of distressed venture thesis. And then the other thesis is sort of just like, go and acquire right now. There's plenty of indie hackers out there that have small businesses that do $5,000, $10,000 a month. And there's really nobody going out and just aggregating all of those. Most of the time, the biggest two reasons we see founders wanting to sell are one, they're tired, or two, sort of on the distressed venture path. They want to be on that venture track. They thought the current vehicle was their vehicle to do so. Turns out it is not, and they want another kind of big swing, and they want to move on from their past project. But for us, especially with our own cash, man, growing 3% month over month, we'll just wait 2 years. Business will double. That's a great, meaningful. It's a meaningful scenario for us with only 3 partners, and from those modest kind of numbers, obviously you can play with the upside, and yeah, what about it? What if you get 6 or 10% month over month? Yes, awesome, absolutely awesome. But if we can just do 3% month over month, have it double in 2 years, that's a great little business for us.
Totally. I mean, I want to touch on a few things that you mentioned. On the first side, on the VC model being a little bit broken, I think that's totally true. And we've had a bunch of guests on touch on this topic as well, where venture is putting money into these companies and expecting them to reach a certain level when sometimes a business isn't capable of hitting that 100 million or billion-dollar valuation, but they've raised rounds and they need to now behave in that way. And so that leads to burning way more capital than potentially they should be, trying to hit growth targets that just aren't realistic, and maybe spending way too much on an acquisition or growth than a business logically would if they were focused on profitability. So totally understand that. And over time, especially with the way markets are going, more assets reach this distressed state. And I get the need to have a capital partner like you that can come in and relieve them of that asset. So I think that's great. And then on the second side, on this point about buying these smaller entities that are profitable, that are growing modestly, I think there's a bigger need for focus on companies like that, because even though they're kind of unsexy businesses, there's a ton of value there in operating them and being the person that's actually bringing in positive EBITDA every single month and having a healthy business.
So let me just say how unsexy these things are that we're buying, or how tiny they are. Our very first acquisition ever, it was making $500 in recurring revenue, which the bar at that time was so low for us, for me in particular. I, as somebody who's technical, it's not my inability to copy somebody else's features, right? Feature for feature, you show me something, I can, copy that in a relatively short period of time. It's not that. It's getting a few customers and a validated use case that was so important to me. And so that business we bought for $23,000. So I was making $500 a month. We bought it for 23 grand. That business today, just this month, is going to do 7,000 in recurring revenue. And the thing takes screenshots of other websites, right? I don't mean to, minimize its use, but it's a single purpose developer tool that does one thing fine at scale, right? We do a couple million screenshots a month for people, and the thing just chugs along. So there's the point that I'm trying to make is that, $500 of recurring revenue isn't meaningful, right? Other than it's a signal that there's something of interest there. But stacking a few of these that then grow over 3 years to 7,000 in recurring revenue, that starts to be meaningful for us, again, from like a bootstrapped scale. Like we started this thing quite small, quite unambitiously, I might add.
When you're buying companies of that size, right, like $500 a month is basically nothing on an annual basis. So I'm assuming that the founding team is all that's there in place. So for you to take over a business like that, talk about how you're operationalizing and making sure that business is actually improving, because you're going to have to maintain a certain level of service or product to actually retain that revenue as well, right?
Yeah, so we have at the beginning, that very first acquisition was do these partners work together? Well, that answer ended up being no, right? The initial group that I put together like didn't work out, and we've been solid now with Danny and Henry for a couple of years. But at the beginning, it was different people, and that didn't work out. We bought them out, etc. It was me doing most of those things, right? I bought that thing and rewrote it from scratch myself. Like that was not something we'd sign up for doing today, but that was, again, for that first one, fine, because I had that use case validated, which, again, given my blind spots as a software engineer, was really important to me. Now, however, we have some shared services because, again, these acquisitions are quite small. Our biggest one is doing a little over 20,000 in recurring revenue and even still at 20 grand a month, that's still not that much headroom to go and hire dedicated, particularly US based talent. So we rely on shared services still, which I have mixed feelings about. But where it does work well is on customer service. So shared customer service, there's one customer service desk for all five of our portfolio companies. It all comes in, through the right domain, right? So the screenshot ones going through that, but it's all one person taking care of everything, and sort of triaging and then assigning tasks to our small development team, which is sort of our second area of shared services. So we have three full-time software developers outside of myself, and they sort of rotate between projects on a monthly basis. And where we've gotten really lucky, if I'm honest, is that, on a few of these products that we've bought, some require more maintenance than others, more upkeep, ship breaks, whatever. For a few of them, I'm not a passive income type of guy. I just don't think that really exists in any meaningful way, at least not for me, you know. Just like there's always going to be a lottery winner, but it's probably not going to be you. That's sort of how I think about that. But we do have, for a couple of these products, they are relatively low touch. And the reason I think they're low touch is because when you're buying on the very small level, this is not the distressed venture thesis. This is the single purpose, kind of single use, does one thing well type of use case. If you buy it and that use case is sort of built out, the product surface area isn't infinite. Whereas with some enterprise SaaS, right, there's always going to be an incremental feature that a new huge customer comes in and says, we need it to integrate with our weird CRM or whatever that is. But if the tool takes screenshots, that surface area of that product is only so wide. And once it's complete, the product is complete, there isn't that much engineering work left on it. And that is, on our shared services model, the biggest cost.
Is
Is
the product and development side.
Yes. And so when we don't have to invest that much on the product side, I mean, of course, we try to build new features, keep up with the market. Maybe we could try this. Great. But it's all sort of like icing on top of the cake. We already have the product. It's feature complete. It fulfills the promise to that customer, and it sort of just grows. Not, I wouldn't say organically, like we're doing growth plays for all of these things, mostly through content. But we can focus on that versus focusing on engineering.
How big is your team right now?
Three full-time engineers and then three partners. Only one of us is actually full-time. Danny is full-time.
Got it. And how do you manage? And I get the model and how you're explaining that, but I guess the more of these entities that you acquire, it's like it's like a common saying, whether you're doing a small project or a big project, it takes the same amount of time in some ways because you kind of got to give it all of you, right? So the more of these entities that you kind of have constant competing priorities. And so how are you prioritizing between these entities, even with the shared services model?
So we stack rank first for the most recent one. So the first 3 months of any net new acquisition, we try not to do multiple at the same time. That's going to be the focus, the newest one. And then once that's sort of on some kind of incremental feature path, then we can sort of stack rank by size, right? What is most important to the portfolio? And then, of course, there's little things like, oh, here's a growth experiment that we've been wanting to try, et cetera. But generally speaking, yeah, it's whatever we've bought most recently, and then whatever's the biggest. I will say something like, I get the reason why everybody goes bigger in this business. Why does everybody try and buy bigger? It's because being able to hire dedicated staff to an individual portfolio company is like a huge blessing, right? That's a miracle. That's amazing. We don't have that luxury. Not yet anyways. And so the more that we can buy these products that are in the single purpose realm, product led growth and nearly complete as a single promise to the customer, it is not true to say that each one of these is the same amount of work. Screenshot was not that much work after we rebuilt the platform, which took me, I don't know, like 3 weeks. Now, when we bought sort of less like a not product led growth, more of like a sales led growth company, like we bought a YC company. They were doing enterprise, like it was just pure enterprise sale. The details don't really matter, other than operationally, it was like very enterprise sales, right? So small number of customers, extremely high touch. Operationally, that was very, very difficult because it took all of Danny's time to handhold these bigger customers, even though the revenue numbers weren't that big yet. Um, and so at some point, we decided to let go of WorkClout and just focus on product-led growth companies. So now, sort of our buy box outside of the fund we just raised is product-led growth, single purpose, and then kind of secondarily, when appropriate, we'll look at like a distressed venture deal. Sometimes knowing full well that it might be a sales-led thing, and we might be okay with that, but we tend to default now to product led growth.
Yeah, it's almost like the PLG plus single purpose tool filters make it easier on the operational side after the fact because you can't have the full-time employees in every situation, and that lets you buy smaller companies. And we've had PE investors that invest down market, but obviously never this down market. But one of the things that they've shared is that the more down market you go, the less competition there is. And so by having this process, you've kind of created a bit of a blue ocean where investors aren't focused and you're one of the only players going after these kinds of companies.
Generally speaking, when it comes down to it, right, you list something on acquire.com. We've been on both sides of this. You get maybe 50 people that are kind of tire kickers looking at it. After a couple weeks, that goes down to maybe three. What I'm trying to say is, generally speaking, when it comes time to write like an LOI, or when it comes down to like writing a check, there's, generally speaking, nobody else in the room with us. Yeah, it is somewhat blue ocean. I mean, there's definitely, we're competing sometimes against individuals, but really when push comes to shove, it hasn't really come down to a competitive process for us for any of our acquisitions to date.
Do you find that that's more because not enough people are focused on those kinds of assets, or just capital in terms of people allocating capital to this area of the market? There just isn't capital chasing companies as small.
Well, I mean, the second you just bring in the word capital, that's already more than like, seven
Yeah,
figures in my mind, right?
right.
So like who is the buyer here other than weird companies like XO, like ours, of which there are not that many to begin with, and most of them are bigger. You're talking about competing against individuals, and then very occasionally other other software companies, almost like a mini kind of strategic. Obviously not at a strategic valuation, but the company sees it as a bolt on, or they could do something there to sort of like a hub and spoke thing. Their main product would be like the mothership, and then there'd be this little bolt on thing would be like a little satellite that complements the business in some way. But yeah, I mean, there's just not dollars going out specifically to chase this part of the market, which is, I think, a unique advantage. I mean, it's not to say it's not a pain in the ass to actually do functionally, but yeah, I mean, there's no dollars being deployed in any meaningful way just to come after these, like, oh, we want to go scoop up all products that are doing under 20,000 of recurring revenue. But I
Yeah,
think
we
that's the opportunity.
yeah, we haven't met all that many firms that are organized or institutionalized in some ways to go after these kinds of assets. The only one that really comes to mind is Tiny by Andrew Wilkinson, but outside of that, haven't really seen that many folks going after it. And I guess if you're competing against individuals, then and there aren't that many of them, it's like them having to write a personal check from their personal account, and that gets real very quickly the further you get along the process.
But even Andrew Wilkinson, who's was part of the he's been a major influence on my thinking, how I approach this. I think Tiny's at 1 billion in assets under management, maybe a little
Yeah,
less now. The market's kind of pulled back a bit. They're public, um, but they're big. I mean, they're not going after these things either. They're going
yeah,
after
yeah,
bigger
yeah.
bigger stuff from us.
Yeah, now that they have the cloud and the deal flow, they're almost looking at slightly or much larger deals than what you're talking about here. So that
Yep.
makes sense. When you're in diligence, how are you validating if an asset is worth buying? Like, what are metrics that you're looking at? What does that process look like?
So all of our diligence, you'll probably laugh at this. It's all sub 30 days.
Yep.
Like from, hey, we like this business to like, here's the check, transaction complete, sub 30 days for all 10 of them. So each one of the three of us, Henry does financials, I do tech, and Danny does sales, and we all kind of do, product and some of the more common things. But we're looking for if it's a product-led growth type company with like a single purpose, just like a single purpose application, we're looking for one channel. So what's the channel that has gotten them the current customer count to date? Is that something we can take over, right? Is that like, for example, we've gotten bitten by this before where the founders had a strong LinkedIn presence, and that was driving a lot of the traffic. But as you know, unless you really get in the weeds, it's hard to say that the traffic from Google was actually coming from LinkedIn, which was actually coming from the founders' personal LinkedIn accounts, which is going
Yep.
to get turned off the second you buy this business. So again, just getting into whatever one channel is working, and even if that's paid ads, that's cool, but we'll dig in there and say, okay, great, we can double down on paid ads or improve them or something like that. So one channel that's working, some number of customers. So we very rarely buy things with zero revenue. We've danced with it in the past. I mean, sometimes it's like these things are 5 or 10 grand and it's just like a little snack to chew on, and we might just experiment with something, or, want like a toy, so to speak. But generally speaking, the second piece after one channel is some number of customers. Obviously, the more the better. A lot of these tools that we're buying are again, not enterprise six-figure deals. So it's like 100 plus customers is great at like $10 a month. That's solid, right? That's some kind of customer diversity. We're hoping for low customer concentration, as is everyone, but we'll definitely say no to deals where, one or two customers make up 75% of the revenue, especially if the company's only been around for 8 months, right? What does that
Right.
actually mean?
Way too
Um,
much risk there.
yeah.
Yeah.
And
Yeah.
then the third piece is just on the tech side, like what are we actually buying? I mostly, I, the way I think about like the tech diligence as the tech guy is not like what is the quality of this code and stuff like that so much is can I make this thing work with our team given our kind of current constraints? So we definitely filter deals based on the tech stack, right? Because our developers and our development team and myself personally, we only know so many different technology stacks. So that can be a filtering criteria for us. Unless, of course, like with our most recent acquisition, it had a contractor that built the initial platform and was happy to continue working with us. And so we pay him hourly to, maintain and do incremental feature development on the thing we just bought. So yeah, customers, channel, and then tech.
What about things like churn, like especially on the lower end of the market, product led, like 90-day retention and just there's higher volume, but people churn in less than a year, and now you don't have the customer base that you kind of started off with. Like how heavily do you vet that side of the business?
We're looking at it. It's so this is Danny hates when I say this because he's like an actual salesperson and like is really thoughtful about these things, and I'm just a tech guy. So when I say this, like, it is naive, but it's also true. Like companies that like are growing tend to keep growing, right? And companies that are like where the churn is like outweighing or outpacing the growth, it's very hard for us historically to turn those things around. So we're absolutely looking at LTV and retention and stuff like that. You have to take numbers like LTV with a little bit of a grain of salt. The business is, under 2 years old, and the founders have never done any pricing experiments. Like, what is LTV really telling you other than like, okay, here's some kind of steady state. But yeah, I mean, having a high, I would take like lower growth over high churn any day, right? Getting like retention metrics up is so hard. I mean, that is like really serious product level work, and we frankly just do not have the time or the bandwidth to do something like that. And so,
So that's a bit of like a Goldilocks zone, right? Where you're buying smaller companies, but they have to have churn figured out, and churn is usually figured out over time. So you kind of have to have this perfect storm of things come together. Or is that not true?
I there are certain products that have some, I don't know, let's call it baseline level of churn. So we own a cold email tool. That industry and those tools in that market segment tend to have higher churn from what we can tell. So there's some kind of, I don't know what you call it, like structural churn numbers that we're looking at, and there's some benchmarks that you can look up. You know, you again have to kind of take those with a grain of salt, but we're not looking for churn to be solved. Again, I think that, you know, when you have only a couple customers and the business has only been around for like less than a year, you know, it's really hard to say. But again, we have a portfolio with a bunch of numbers that we're comfortable with, and so we benchmark their current churn with the rest of the portfolio and see if it's something we can manage. Or we look at it and say, like, you know, here's why people are churning. There's like all these bugs, or there's something obvious, some obvious levers we could pull to reduce churn. We're comfortable with that.
Right. How are you valuing these businesses? Like, is it a multiple of revenue? Are you looking at profitability? Like, what's the framework there?
It's multiple of revenue.
Well, and is it? I've seen some articles that you've written. It's like 2 to 3x type of on the revenue side.
Yeah, two is great. Three is like three's a maybe for us.
Threes maybe. I got it.
Yeah.
Okay. And in terms of structuring the deal, like, are you paying most of this upfront, or are you financing it?
Relatively low seller financing, if any. We don't have, there's only one portfolio company now that has any kind of debt on it, and it's 200 grand of seller financing on like an $800,000 purchase price. So, um, relatively small debt and no outside debt, just some seller financing with
Right.
zero interest if we can get it.
That'd be a little harder right now, but yeah, I hear you. Okay, and then you mentioned you raised a new fund, so I think maybe that'll be the last series of questions. Just help me understand with the 500,000. You said instead of buying multiple smaller assets, you want to go after one larger asset. So what's the thinking there?
So I tried to raise like a proper fund during the heyday of, you know, 2021, 2022. I was talking to all the same people that were putting dollars in these YC companies at just bonkers valuations, right? But for some reason, when it came to our little portfolio, they were like, "Oh man, like a 3x on this whole thing. I don't know if we can go for that." I'm like, "Okay, guys, whatever." So I failed to raise capital, just like a discretionary fund. For we were going to just sell shares of our current portfolio and say like, "Okay, we value the business today at X, and it's not going to be a fund, really. It's just like, here's one C corp that has the whole portfolio in it, and go raise into that." And that didn't
Right.
work. But part of the feedback from that process was, I don't want my capital tied up for, you know, 10 plus years. That's hard for me. Um, and so we came up with this concept of, like, that was basically the number one objection. Um, and so we came up with this concept of a flip fund. We don't generally buy these things to try and flip them or sell them in any kind of time horizon. The ones with our own cash, it's definitely just been opportunistic. And again, some of these I think will hold for a very long time. They've already cash flowed much more than we paid for them. Like, there's no real reason to sell them. But for the flip fund, the structure that worked, that I thought I could go raise against, was, we're going to hold for 12 to 24 months. We're going to try and double the business, and then we're going to sell it. And that pitch was really easy to understand for my audience, or the people that I had access to or have access to. And we were able to raise 500,000 in a couple weeks, and that's it. So it's not really a fund. It's more of a fundless sponsor model, but it is discretionary, and we'll go just buy one company with that.
And within the 12 to 24 months, like, what's the priority of things that you're working? Are you trying to clean up the business, make it more profitable, or change the product a bit? Like, what's the focus there?
So it's hard to say without having a target identified. We're looking at a deal right now that is a legacy thing that could use a bunch of cleanup and be brought at least to 2010 and then ultimately to 2023. It looks that old. And that I would kind of frame as like, okay, this deal has a packaging problem, right? So for the next 12 to 24 months, I'm working on packaging this and updating this to be like a modern kind of pure SaaS offering. There's some service elements there, so that would be kind of the dance if we bought that product. Um, but on like a complete other side, right? We're looking at another deal that is sort of distressed venture, raised a bunch of money, running out, ran out. They want to return money to investors, and we'll buy it for 2 or 3x revenue, and that already has a growth rate. They have some growth plays. Let's say content is the channel that's working for them, or SEO, and so it would be about reinvesting in that.
And over time generating more value. Okay, that makes sense. In terms of the timeline, it feels condensed. So I guess the question is, like, when you find these targets, you have to find one where you feel like you can create enough value that flipping it in 12 to 24 months is enough, right? Because normally PE firms, their hold periods are at least 3 years, or usually 5 is like the average. So how do you find an asset where you can flip it around in that quick of a time period?
Well, we'll see if we can. There's a great possibility that we'll come away in like the end of the year, and we'll look around and say, we can't find a target. Do you guys want your money back? I'm perfectly happy giving the money back if we don't find. I don't want to buy something just to buy something if I don't see a good play or a good opportunity, or it's not something, it's not if it's not a deal that we would do with our own cash. It's not a deal that we're going to do with these investors. The time horizon is condensed. One of the rules that we're thinking about bending on is actually more of a sales-led product. Is actually, I think, a little bit easier to double in that short of a time horizon. For example, if we're buying like a pet care, like a back office software for like the pet care industry, like, I don't know, mobile dog washers, I can get a list of all of those, literally every single one registered in the United States, and put it on a spreadsheet and go try and get like a yes or a no from all of them, right? And if that business has 10 customers today, I can go I have some confidence that I can get to 20, just because it's so clear how you would target and go after those businesses. And so that might be one approach that we're viewing the flip fund, one lens through which we're viewing the opportunities for the flip fund. But as you well know, I have no idea what's going to come on the market in the next 2 months. No idea. So we'll
Right.
see.
Right. Yeah, I think the fact that you're open to not investing in something if you don't find the right target, I think is the right approach. And you might find one that does meet all the criteria, and then it makes sense. So I think that's encouraging. So with that said, I think that's a good place to stop. But before we take off, just what are some places where people can go to learn about XO and this type of an investment philosophy and learn more about you guys?
So we write a weekly blog. You can go to exo.capital. And I do a little podcast there, just going over our thoughts or growth experiments. We're super transparent with our numbers. So every month we release like all of our numbers and all the stuff that worked and all the stuff that didn't work. So we sort of air our dirty laundry on the blog. And then I'm still posting on Twitter, or X, which I have not gotten used to saying. I'm at Andrew Pierno, which we can link to. Those are the two main places, and LinkedIn, of course.
Awesome. And last question, are there any resources if somebody's listening and they're like, I'd like to get into this type of micro investing approach or building a portfolio of these businesses? What is a book or resource you'd recommend that they look into or read into?
So that was the original purpose of the blog, is to just say like, okay, we're doing this from scratch, follow along. Here's all the lessons. We're not hiding anything. We're not gatekeeping anything. There's no course to go by. It's just like, hopefully pure value on the blog. And not to say that we may not do, we won't do a course in the future or something like that, but to date we just haven't. So that's what I'd recommend if they want to set up what we have.
There's some good content in there. Some of the articles we research is you have an article on negotiating a micro SaaS acquisition, so we're checking out. So we'll put that in the show notes as well.
Awesome.
Awesome. All right. Well, Andrew, thanks for doing this, and appreciate you sharing your wisdom with the audience.
Thanks so much, Shiv. Thanks for having me.
Yeah. Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you enjoyed today's content and want more of it, please subscribe to the podcast on your favorite podcatcher. Number two, if you are in the market for marketing strategy consulting services, due diligence services, or fractional CMO services, please visit our website at www.howtosaas.com and schedule a consult today. And number three, if you haven't already, grab a copy of my book, Post-Acquisition Marketing. It's available on Apple Books, on Amazon, and any bookstore that you can find online. Get a copy because it walks through the framework that we take all of our clients through, and it'll definitely add value to your business. And that's it for today. We'll see you guys next time.